Hey guys, I hope you all are doing great. Welcome to the next episode of the Audit Practically series. Today we're going to be looking at the Fema compliances in relation to both receivables and the payable balances. So guys, what are you waiting for? Let's deep dive into the video and decode content that's worth gold. Yeah, just presenting my screen. Just a moment, guys. Yeah, I hope my screen is visible. Yeah, it is. Just a moment. Just going a bit up. Yes, guys. So basically, first, let's break this into two aspects. First, the receivables aspect and the payables aspect. Guys, your FEMA receivables, they should be realized within 9 months from the date of export. That is, when you're exporting goods or services to a country outside India, then the same needs to be realized within 9 months from the date of export. And in relation to payables, when you're importing goods from or services from a country abroad, then the payment in relation to the same should be completed within 6 months from the date of shipment. I hope it is very clear, guys. However, in relation to receivables, where the receivables are in relation to warehouse established outside India, the 9 months would be replaced by 15 months. So you would get an extended time period there, where the same is in relation to export to warehouse established outside India. I hope it is clear, guys. Okay, so coming back to payables, let's say the payables, that is the foreign balance payables, have not been settled for a period beyond 3 years. In such a scenario, the entity needs to mandatorily get the RBA approval. However, if it is greater than 6 months, but less than or equal to 3 months, in such a scenario, the entity can still get an extension by the AD banker, which is what I have written here. So basically, where it exceeds 6 months but is within 3 years, the entity can approach the AD banker and request him an extended time frame for the payment to the entity outside India, that is to the supplier outside India. I hope this is clear, guys. However, if the same exceeds 3 years, as I told you, RBA approval is compulsorily required, guys. And the entity has another option. So where the foreign balance in relation to payable is outstanding for more than 3 years, the entity can also choose. So this is optional, guys. This is not compulsory. Entity can also choose to convert the same into an ECB. ECB is basically an external commercial borrowing. So guys, if your entity or if your client has exercised this choice of converting the same into an ECB, you as an auditor also need to ensure that the ECB compliances are adhered to, because there are separate FEMA compliances in relation to external commercial borrowing as well, and you need to ensure that the same is adhered to, guys. I hope it is clear, guys. Next, so in relation to receivables, let's say the receivables are outstanding for a long period of time. So the FEMA also gives you an option to write off the receivables. As an auditor, you also need to understand when an entity can write off the receivables and what the guidelines say in relation to this, so that you are also able to verify whether the write-off is in line with the guidelines or not. So guys, in relation to the write-off of the foreign currency receivables, we will be discussing that as a separate segment in the time to come, in a few minutes down the line. Yeah. So next, just coming down to receivables and payables netting off, guys. Okay, you all would have this question. Let's say I exported goods to a particular supplier A. Let's say let's say I exported goods to entity A outside India. Let's say I also imported some goods from entity A outside India. Can I net these balances off? Can I do netting off of these balances and show it as a net receivable or net payable? Guys, yes, you can do it, but there are certain conditions which you need to keep in mind before you do the same. Yes. So what are these conditions? What do you as an auditor need to know when an entity does something like this? Yep. Just coming down, guys. So AD category 1 banks may deal with the following requests received from the exporter or importer constituents for allowing set off of outstanding export receivables against outstanding import payables. Okay, so these are the conditions which they are specifying. So set off of outstanding export receivables against outstanding import payables from or to the same overseas buyer or supplier. Guys, do you remember when I started off the example, I gave the example with entity A. I did not bring entity B into picture. I did not bring entity C into picture, because the netting off can be done only when the supplier of the goods or services and your customer are the same person. That is, it is one and only one entity with which you have a payable relation and a receivable relationship as well. I hope you understood this. Okay, next one. Set off of outstanding export receivables against outstanding import receivables with their overseas group or associate companies, either on net basis or gross basis, through an in-house or outsourced centralized settlement arrangement. So what they are saying is, in our example, we spoke about entity A, which was outside India. So let's say entity A has certain group companies. Let's say you have a receivable balance in relation to entity A, but you have a payable balance in relation to one of the group entities in entity A. Can you set that off? Yes, you can, because it is saying overseas group company. Similarly, let's say entity A has an associate. Let's say you have a receivable balance from that associate, but you have a payable balance towards entity A. Can you set it off in that case? Yes, you can. So this is what the regulation is saying, guys. So if your client does something like that, it is within the regulation and it is fine. So you just need to keep this in mind, guys. Yeah. Next, the setup shall be subject to the following conditions. The arrangement shall be operated and supervised through / by one ED category bank, one bank only. So what they're trying to say is, when you're doing the setting off or the netting off, it has to be supervised by one and only one AD banker. So let's say HSBC is one of your AD bankers, only HSBC should do the supervision. SBI cannot be another AD banker. So it basically says that only one AD banker should be supervising this. I hope you understand this. Then the AD category 1 bank is satisfied with the bona fides of the transactions and ensures that there are no KYC, AML or CFT concerns. KYC is know your customer, AML is anti-money laundering. So your AD banker, in our example HSBC, should be comfortable with the fact that there are no security concerns in relation to these. Then the invoices under the transaction are not under investigation by Directorate of Enforcement or Central Bureau of Investigation or any other investigative agency. Okay guys, let's take an example to understand this. Let's say you have two export invoices. Like this, you have two export invoices to entity A and you have one import invoice from entity A. So what they are saying is, out of these three invoices, not even one should be subject to investigation by these three authorities, that is Directorate of Enforcement or CBI or any other investigative agency. Even if one of these invoices is subject to any investigation out of the three, you cannot do the netting off. I hope it is clear, guys. Next. Import or export of goods or services has been undertaken as per the extant foreign trade policy. Guys, this point is very, very important. You might be thinking, what, this is very simple to understand. What is important in this? Guys, when we come to the climax, you will understand the importance of point D. So I'm just parking it right here. Let's just wait for the climax to come, right? Okay. The export or import transactions with ACU countries are kept outside the arrangement. So guys, RBI has given countries which are included in the list of ACU. Maybe if you want that, I can just pin it down in the comments. If you want it, just comment down below and I will pin it down in the comments. And just keep in mind that China is not in the ACU countries. So basically what they are saying is, if you are having export or import transactions with countries which are that in the ACU countries list, you cannot do the netting off. So with China, you can basically do the netting off because China is not in the ACU countries list. I hope this is clear, guys. Okay, next one. Set off of export receivables. Again, point F. It's a very important point. Set off of export receivables against goods shall not be allowed against import payables for services and vice versa. Yes, what they're basically saying is, let's say I exported goods to entity A. Let's say entity A rendered some service to me. Is setting off allowed? You guys might be saying yes because it pertains to the same entity. But no guys, this is where the point is coming and saying that if I have exported goods to entity A should have exported only goods to me. That is, I should have purchased goods only from entity A for the netting off to be applicable. So that is, if I'm exporting goods, I should only be importing goods for the netting off to happen. If I'm exporting services, I should only be importing services from the same party for the netting off to be applicable. So it cannot be a scenario wherein I'm importing goods, but I'm exporting services to the same entity and I can net off. So in that case, you cannot net off. So it has to be goods and goods or services and services. I hope you understood this, guys. Next one. AD category 1 bank shall ensure that import payables or export receivables are outstanding at the time of following set off. Yes, it is obviously implied. You are setting them off because they are outstanding. So this is quite self-explanatory. Further, set off shall be allowed between the export and import legs taking place during the same calendar year. This is very important, guys. So what is happening is basically our start audits are usually for financial year standpoint. So some of you might get confused and look at the year as a financial year. So this is where the Fema regulations are coming into play and saying that, boss, you have to look at it as a calendar year. For example, let's say there is a transaction that took place in April 2024. That is, you exported to entity A in April 2024. And let's say you purchase goods from entity A in Jan 2025. Can netting off be done in this case? No, guys, because April 2024 falls in the calendar year 2024, while your Jan 2025 falls in the calendar year 2025. Even though both these transactions fall in financial year 24-25, you cannot do the netting off in financial year 24-25 because these are in two separate calendar years. I hope it is very clear, guys. And if any of your clients have done the netting off despite these falling in two distinct calendar years, then the treatment done by them is wrong and you would have to look at the implications on the report. I hope this is very clear, guys. Yeah. Next. In case of bilateral settlement, the set-off shall be in respect of the same overseas buyer or supplier subject to it being supported by verifiable agreement / mutual consent. So what they're basically saying is when you're netting off the receivable and payable balance in relation to entity A, you also have to get an agreement, or you also have to get the consent of entity A that you're going to net off the balances. I hope it is clear, guys. Next, in case of settlement within the group or associates companies, the arrangement shall be backed by a written legally enforceable agreement or contract. Okay, more or less similar to what we are seeing. Then above, so what we saw above. Then AD category 1 bank shall ensure that the terms of the agreement are strictly adhered to. Okay, this is fine. Next, set off shall not result in tax evasion or avoidance by any of the entities involved in such arrangement. So let us say the set off is done maybe to avoid tax, then that is not right, guys. So such a set off cannot be encouraged. So it can be evasion of tax in any of the countries. It could even be evasion of tax in home country, that is India, or the country outside India where the transaction is taking place. So tax evasion is not allowed in any of these countries. I hope it is clear, guys. Next, third party guidelines shall be adhered to by the concerned entities wherever applicable. So let us say a third party regulator has also issued some guidelines in relation to this. In addition to this, those guidelines or regulations also need to be adhered to, guys. I hope that is what they are trying to say, right? Next, AD category 1 bank shall ensure compliance with all the regulatory requirements relating to the transactions. Next, AD category 1 bank may seek auditors or CA certificate wherever felt necessary. Again, this is general. Next, each of the export and import transaction shall be reported separately in FETRS, EDPMS, IDPMS as applicable. So basically these are the transactions where the export and import will be reported, guys, and your AD banker will have access to these portals. That is like your EDPMS portal will also give the access to the AD banker for him or her to be able to see the transactions in relation to import or export as well, guys. Next, AD category 1 bank to settle the transaction in EDIPMS by utilizing the set of indicator and mentioning the details of shipping bills or bill of entry or invoice details being settled in the remark column, including details of entities involved. So basically this is not for the entity to comply with, this is basically for the AD banker to comply with. As I told you, there is a portal called EDPMS, guys. So what will happen is, let's say I have 100 of receivable from entity A. Let's say I have 80 payable to entity A. So the net receivable which I would be having from entity A is rupees 20, right? So what would happen is basically the AD banker in the EDPMS portal has to set this 100 and 80 off and say that 20 is the net receivable, and he has to say that the entities which are involved in this process are us and entity A, which is the other entity outside India. So this is what the AD banker has to say, and he also has to annex the supportings. Like for example, in relation to export, it has to be the shipping bills. In relation to your import, it has to be your bill of entry. So these details also need to be annexed to by the AD banker in the EDPMS portal. I hope it is clear, guys. Yep. Next. But there is a twist. What is the twist, guys? I told you in point D there is a twist which we will be seeing. Import or export of goods or services has been undertaken as per the extant foreign trade policy. Okay. Now what is the extant foreign trade policy saying, guys? Okay. So there was a change in the foreign trade policy procedure in 2023. What is that change? That change was in para 2.74. Okay. So here is the twist, guys. Let's go to the twist. So para 2.74, offsetting of export proceeds. Subject to the specific approval of RBI, any payables or equity investment made by an authorization holder under any export promotion scheme can be used to offset receipts of his export proceeds. In such cases, offsetting would be equal to realization of export proceeds, and exporter would have to submit the following additional documents. So basically they are saying that netting off is allowed, but here is the twist. Subject to specific approval of RBI. Here is the twist, guys. Here is the twist. So before, in the above paras which we were reading, we came to a conclusion that AD banker only has the power to allow the set off, and you need not go to RBI for the set off. But there is a change in the status quo right now, and only RBI can allow set off. Permission, AD banker's permission would not hold good. I hope this is clear, guys, because obviously as per your interpretation of statutes, the statute that is later in time would prevail over the one that is earlier in time, and this one came in 2023, whereas the regulations we read above were earlier than this one. So this is the one which would prevail right now. And if your client has not sought RBI approval for netting off and argues that AD banker approval is sufficient for netting off, then your client's contention is wrong, and you would have to evaluate the implications on your audit report as per your SA 705, which is modifying the opinion on your independent auditor's report. I hope it is clear, guys. So what else are they telling us to submit? Appendix 2L in lieu of bank realization certificate and specific permission of RBI. So you need specific permission of RBI for netting off. That is what they are trying to say. That is what I've said. The devil is in the details. So you need to be updated with the changes in the regulations. You need to read in between the lines because every single thing counts here. I hope that is clear, guys. So Appendix 2L tells you to provide the RBI permission letter copy. That is where RBI is telling, boss, you have sought permission from me and I am okay with the permission that you have sought, and I allow you to net off the receivable and payable balance. That is what is meant by the RBI permission letter, guys. I hope it is clear. Then a certificate of CA or CMA stating that the RBI guidelines in relation to netting off have been perfectly adhered to, and the fact that the entity has appropriately sought the permission of RBI for netting off. I hope it is clear, guys. Next, letter from the parent company or buyer indicating consent for offset. Like that is in our example, as we said, you need to get a letter from entity A or entity A's parent company indicating that they are 100% agreeing for the net off arrangement and they are perfectly fine with the same. And next, there are other few general declarations which are also there. So not very relevant now. Maybe if you want, I can maybe pin the link in the first comment and you can maybe read them on your own interest if you want to. Yeah. Next. Export receivables write-off. So initially at the start of the video, we told that we will be looking at the export receivables write-off as well, and that export receivables can be written off after a specified period of time, right? Let's come to them, guys. So export receivables can be written off when they are outstanding for greater than 1 year and sufficient documentary proof for efforts with respect to recovery. Let's say I am an entity and I have made a lot of efforts for the amount to be recovered from entity A, who is my customer outside India. So I have to prove that I have taken sufficient efforts to recover the amount. Merely showing call records won't suffice. I have to show documented email proof that I have taken sufficient efforts to recover the amount from my customer who is outside India. I hope it is clear. Then export incentives to be refunded along with interest. So if the export receivables are outstanding for more than 1 year, I would have got some export incentives like my ROTAP. So MEIS, SEIS are not in play right now. So ROTAP is the scheme that is prevailing right now. So I need to maybe refund any incentives I would have received in relation to the same along with the interest. So that is there. And there are 7 other conditions which need to be satisfied. Refer below. So before referring the 7 conditions here, we will just see what is the limit for write-off. So particulars, self write-off by an exporter other than status holder exporter. So most of your clients would not be status holders. So this is the limit that would apply to them, guys. So it would be 5%. But 5% is not the limit that would apply to them, guys, because this is voluntary write-off by an exporter. But this is just theoretical, guys. I'll tell you why. Because if you remember, I told you that your AD banker also has access to the EDPMS portal, and your write-off would be happening on the EDPMS portal. So since your AD banker has access to your EDPMS portal, he is 100% aware of the fact that you're going to do a write-off. So you can never do a self write-off. Your AD banker will obviously be intimated when you're doing a write-off. So this 5% is not practically relevant, guys. This is just for theoretical purposes. If I just come down, write-off category by AD banker, AD category 1 banker, 10%. So basically 10% is the limit that would apply to the entities, guys, on a very, very normal scenario, because as I told you, 5% is just for theory's sake. It does not work out like that in real life. So 10% is the limit. 10% is the maximum write-off limit that you are allowed to do. But this 10% is applied on which number, boss? Yes, coming to that. Total export proceeds realized during the calendar year preceding the year in which the write-off is being done. Let us say a receivable balance is outstanding for maybe 1 year, 2 months. In 2025, I decide that I want to write off this receivable balance. So what do I have to do? So maximum I can write off 10%. I can write off 10% of export proceeds realized during the calendar year. So I am writing off in 2025. So the maximum I can write off is 10% of my total export proceeds which I received in calendar year 2024. I hope you understood this, guys. I hope this is clear. Okay. Next, let's come down to the 7 write-off conditions. First, the overseas buyer has been declared insolvent and a certificate from the official liquidator indicating that there is no possibility of recovery of export proceeds has been produced. Okay. Next, the unrealized amount represents the balance due in a case settled through the intervention of the Indian Embassy, Foreign Chamber of Commerce or similar organization. So this is again if the amount is settled through your Indian Embassy or Foreign Chamber of Commerce or similar organization, but it still remains unrealized. In such a scenario, you can go ahead with the write-off. Next, the goods exported have been auctioned or destroyed by the port or customs or health authorities in the importing country. So let's say, for example, entity A is in Hong Kong. I exported goods to entity A in Hong Kong. Let's say the goods got destroyed in the port or customs or health authorities in Hong Kong. In such a scenario, again, I can go for a write-off. Next, the overseas buyer is not traceable over a reasonably long period of time. Okay, this is again simple. Next, the unrealized amount represents the undrawn balance of an export bill not exceeding 10% of the invoice value remaining outstanding and turned out to be unrealizable despite all the efforts made by the exporter. So, just a moment, guys. Just a moment. Yep. So coming to point 6, the cost of resorting to legal action would be disproportionate to the unrealized amount of the export bill, or where the exporter, even after winning the court case against the overseas buyer, could not execute the court decree due to reasons beyond his control. So what they are saying is, if the cost of recovering the amount is, let's say, 100 rupees, but the receivable amount itself is 90 rupees, there is no point in proceeding ahead with the same, and you better write it off. That's what they are trying to say. Next, bills were drawn for the difference between the letter of credit value and actual export value, or between the provisional and the actual freight charges, but the amounts have remained unrealized consequent on dishonor of bills by the overseas buyer, and there are no prospects of realization. So what they're trying to say is, let us say a letter of credit to the extent of 90 has been given and the export value is rupees 100. So in such a scenario, what would have happened is, you as an entity would have already raised rupees 90. The unrealized amount would have been rupees 10. And let's say there are, let's say, and the next one, between the provisional and the actual freight charges, but the amounts have been unrealized. Let's say you provisionally tell your customer in Hong Kong that, boss, the freight charge would come out to rupees 100. But actually the freight charge comes out to rupees 110. So to the extent of 100, the customer would have already paid you the same. However, to the extent of 10 differential, the customer wouldn't have paid you, and that is remaining outstanding. So this is what they are trying to say. If the to the extent of the differential that is remaining outstanding, and if the same is unrealized, you can write it off. That is what they are trying to say, guys. Okay, next. Audit reporting requirements. Guys, so what are they trying to say here? Basically, what do we need to do? So guys, as I told you earlier, in your audit report, you need to report the receivables that are outstanding for more than 9 months from the date of export, and your payables which are outstanding for more than 6 months from the date of shipment. I hope this is clear. Where you need to report in your audit report is the matter of discussion we are going to engage in now, guys. Just coming down a bit. Yep. So in your audit report, as I told you, give details of Fema receivable balances outstanding for 9 months, more than 9 months, and payable balances outstanding for more than 6 months. If the AD banker has approved the outstanding balances, then you have to report the same in your emphasis of matter paragraph, saying that as on March 31, 2025, our entity has so and so amount of receivables outstanding for more than 9 months, and so amount of receivables outstanding for more than 6 months. And as per the Fema guidelines extent, we have obtained permission from our AD banker who has approved the same. However, if the AD banker disapproves the extension, in such a scenario, it would lead to a modified opinion, guys. And whether it results in a qualified opinion or an adverse opinion depends on the pervasiveness. That is, if the payable balance or the receivable balance covers a major chunk of your balance sheet, it would result in an adverse opinion. However, if the receivable balance or payable balance do not represent a major composition of your balance sheet, it would result in a qualified opinion, guys. I hope this is clear. And as I told you earlier, if the amount is outstanding for greater than 3 years in relation to payable, and if RBI does not approve the extension in relation to the payable balances which are outstanding for more than 3 years, you need to modify your opinion in your report. And in this scenario, an adverse opinion would be preferable because the matter is pervasive. And the legal cost in relation to the same would also be huge, and the impact on the entity would be severe because of this. I hope this is clear, guys. Next, just coming up. How do I find out the balances which are outstanding for more than 9 months and more than 6 months, guys? Very simple. So assuming 31st March 2025 is your balance sheet date, do 31st March 2025 minus your date of invoice for both receivables and payables. But we saw it was date of export or date of shipment, right? But we take our date of invoice on a conservative basis because it usually tends to be earlier than your shipping documents date, and it can be traced to your financial records. Because if you're an SAP client, if your client is using SAP, you will know that in your SAP listing, you will be able to see the invoice date, and you can trace it there also. So you can basically trace the same back to the financial records, and on a conservative basis, it is also slightly earlier than an invoice date. So you can also ensure that you're getting more comfort over this number. I hope this is clear, guys. So what you can do is, you can take 31st March 2025 minus your date of invoice, and you can find out how many days are coming for each of these balances. Then just keep this in mind, guys. This is very important. Even your INR receivables and payables from or to entities outside India should be considered. Let's say I have exported goods to entity A outside India, which is in Hong Kong. Let's say the export bill is in INR. Will FEMA apply to this? Yes, guys. Even in this case, FEMA will apply. Even here, you will have to check the 9 months time limit, guys. I hope it is clear. Okay, let's take an example for our reporting. Let's say for payables, let's say the invoice date is October 1, 2024. Let's say the year end is March 31, 2025. So when you do March 31, 2025 minus October 1, 2024 in your Excel, you will get 182 days in between. Some of you might say it is exceeding 6 months, you need to report it. No, guys, it is not exceeding 6 months. Just look at this. October, November, December, Jan, Feb, March. It is exactly 6 months. It is not exceeding 6 months. So you need not report this, guys. I hope this is very clear, guys. Guys, if you found this session insightful, just a moment. Yeah, guys, if you found this session insightful, do hit that subscribe button and do support the video because a lot of effort has gone into it. So do keep learning, do keep growing, do support the channel, and do share this to your friends if you found it useful. Thank you so much. Cheers. I'll meet you soon. Thank you.